20 people. So
Yeah, you guys blow this out to Facebook, right? So it's not like they can ask a lot of questions on the actual. Oh, you're actually. Is it live on Facebook now?
yep, I
Oh,
well it'll in like 3 minutes, and now it's live on Facebook. All right, there we go.
very cool. Yeah, so are they able to ask questions to you then, and then they can pass them on to me if they have anything?
Yep, it'll likely appear in the comment section, but we have a few that we saved up from people dropping in the form for the event.
Okay,
So,
perfect.
we figured we'd go, with your presentation first for the first few minutes, and then we'd go over general questions, and then those Q&A questions from the form.
Perfect. Yeah, whatever I have to do. Oops. What is on here? I'm not even sharing my screen right now, I don't think.
Oh, let me. Uh,
Let me end this one. There's this one.
Making you co-host real quick. Does that help?
I can do it. I can do it. I'm already good.
Okay.
I just hadn't been sharing it, so I'm just moving you guys around so you don't see eyes darting the whole time. I have
Yeah.
3 monitors and one that I can look at all the time, and the ones all over the place that makes you look like you're scoping out the room.
Yeah. Okay. So in about a minute, there's going to be a rush of people because they always wait until the calendar reminds them. So this is always fun to see.
I don't think I can see any of the stuff you see.
Oh, you can not see the other participants?
I could see your participant. Oh, the Facebook Live. I don't think I can see everybody.
Oh, gotcha.
The
Okay.
rest of it, I can see a few.
I see.
Yeah, you guys have a huge following online, I believe.
Yeah, we hit 6,000 last month. So
Congratulations. That is really awesome. And that's amazing. And that's neat. And we've all seen over the last few days what an online group of people can do.
Yeah, we saw a deal in Austin, and it ended up somehow people pitched in about 3 million within like the day. So we were like, all right, this is we're yeah we're big. We're doing big things.
That's really cool. How did you do that one? Did you crowdfund it or something?
Not even. It was just like we saw a deal, and then we asked, hey, we're going to talk about this. Anyone interested in like chatting and figuring out? And then a bunch of people just pitched in, and they gave the amount that they wanted to, invest in it, just because it was like wholesaled. So because it was wholesaled, it was like we were planning hard money, but then everyone ended up giving enough to just give a full cash offer. So
Nice.
we probably
Wow.
won't move on it, but it's right now Austin's just a little too expensive. But
Austin's great.
it was like a fun learning lesson for the group of us.
So what did you guys do? Put it together in like a syndication, take it out, and then you're gonna sell it, or are you gonna hold it?
Yeah, the plan was yes, kind of syndicated. It was gonna be like hard money, and then we just sell it off, and then because it was the project was supposed to be 11 duplexes, so that was it was gonna be, the listing price was like 4 million, and we did the numbers and we're like, all right, 3 million makes sense. So it was kind of like a fun, all right, can we make 3 million happen? And then it did. So
That's amazing. That's absolutely amazing. That's really cool.
shows you the power of a bunch of people on the internet, right?
Absolutely. I like I'm vindictive about Wall Street, so I kind of feel good about when I'm on GameStop and
I feel like everyone was like kind of siding against the hedge funds, so
well, they've been manipulating the markets for years, and that's a brick and mortar business that they were trying to put in the ground. You short 130% of its stock, like that's pretty vicious. I shouldn't say if we're being recorded.
Yeah.
I just look at it and say it was interesting. It's going to be something that we'll be writing about and investigating for months and months and months.
Oh, Yeah, this is historical. Just every month, something new, you know.
We live in weird times.
All right. Eliza's on as well. She'll be taking charge of asking questions for this.
Mhm,
I will be backburning to her. So,
mhm,
um, and then let's start in about 3 more minutes, 7:05. Just to
mhm.
get people.
Sorry.
Right.
How's the lighting, by the way? You guys all see pretty good?
Yeah.
You guys all look great. Hi, Liza.
Hi, Toby. How's it going?
Awesome. So
Great.
where are you guys all at right now?
I'm in the Bay Area.
Mhm.
Chicago moving to Austin. Moving to Austin. So
And Annie, where are you? I see Annie.
Oh,
Any,
I'm in San Francisco.
San Francisco.
Yeah.
How is it
Drove
there?
like a maniac just to come and be here on time today. So yeah,
Good
I'm
job.
super excited.
We just closed today on an apartment complex ourselves. And one of those never ending sagas of trying to get it closed because you have a seller who realizes that they were running it really poorly. And we
yeah.
got control of it for 90 days before we closed. And it's probably the worst thing we could have done because we had it full. And they was like, oh, maybe I don't want to. So the unwilling seller, we had to drag him across the finish line.
Yes, we encountered something similar. The seller like has been behind on utility bills, so the city's got a lien, and we just found that like a week before we were supposed to close. So
Yep.
that's
I
always
get
fun.
$96,000 water bill. The only reason it wasn't shut off was because it's COVID.
All right, 7:05. You ready to take it over, Lisa?
sure. Hi, everyone. Thank you guys so much for joining us on this tax planning workshop where we're so excited to have Toby Mathis from Anderson Advisors to join us and give us a presentation and help us with the tax planning for 2021. So Toby is a founding partner of Anderson Business Advisors, and he helped Anderson grow its practice to a thriving tax practice, serving tens of thousands of clients nationwide. Toby is also a real estate investor himself, and he used to flip houses in Vegas, and he still has many real estate projects going on throughout the US. Toby is a member of the Forbes Real Estate and Finance Council and has authored several books, including Tax-Wise Business Ownership and 12 Steps to Running a Successful Business. Toby also teaches extensively throughout the US to groups of investors and professionals, with many of his courses certified for continuing education at credit for legal, accounting, and real estate professionals. And we're so excited to have you, Toby. And thank you guys. Thank you so much for joining us and to share your knowledge with our members.
Oh, absolutely. It'll be fun. You want me to take it from here?
Yes, please.
Absolutely. I always laugh when people give they talk about you whenever I start. So thank you so much for kindness. I'm a tax lawyer by trade, but I'm a real estate investor. Have my partner and I have a couple hundred properties nationwide, actually above that. We have everything from apartment complex, mobile home, single families, office building, warehouses. We run the gamut, been doing this for 23 years. Our firm, you already were nice enough to talk a little bit about us, but about 300 tax professionals, attorneys, bookkeepers, administrative professionals, all designed to help people basically keep what they have, keep it away from lawyers, snoops, Uncle Sam. Make sure that they're able to create a legacy and pass it on. Things I like to share about us, just because you've all probably met attorneys and accountants, and you want to run the other direction because they're going to bore the pants off you, is we try to align ourselves with our clients. We come up with a lot of innovative products that are designed to not be hourly, so that you don't feel that weird sense of anxiety when you call up, you're going to get an hourly bill or anything like that. We try to make it to where it's just open, you can share. We work with our clients really well to make sure that they're putting money in their pocket, but we do it with our employees as well. So we've been a national this year. I'll just give you the things that we won this year. We're actually a top accounting firm in Seattle. We were number 2 last year. We've Vegas Review Journal named us the best places to work in Las Vegas. We have 3 offices down here, about 225 of the employees, 250 are right in this city. We have Tacoma, Washington, Cheyenne, Wyoming. We have offices in Salt Lake and in Arizona, small offices. And then we're in all 50 states as a registered agent. But then Intuit named us a firm of the future because we do leverage our technology. And we want to make sure that our clients, no matter where they may be, are able to do their business. We don't want you to be tied to a desktop. So we try to stay as far out as we can as far as technology to leverage as much as possible. Today, we get to talk
Just
about.
want to add really quickly, sorry. Both Nelson and I, myself, are actually clients of Anderson Advisors, and we use Anderson to help us set up our entity structure and for asset protection purpose.
Yeah.
They're amazing.
Yeah, especially yeah, a lot of our real estate holdings go through Anderson, but let me know if you have any tips for how to manage all my GameStop stocks. So that's
Don't sell it. We're short squeezing them, right? Unless you're the hedge fund, in which case we love you. We just don't want you to short the hell out of the company and put it out of existence. Love, I just think that's so much fun. I don't know how much you guys read about that. I just find that really fascinating, that the hedge funds are mad when they colluded together and squeeze the heck out of these poor companies by shorting over 100% of its stock. Then they're mad when people rise up against them and put them, and play their own game against them. I just find it fascinating. But anyway, today we get to talk about tax laws, and I'm sure everybody loves to pay taxes, and that you wish you all could just pay more of whatever you make. You love giving it to the government. I'm going to assume that that's probably not accurate, and that you may rather keep more of it in your pocket so you can invest it. In the whole world of taxation, I'll put it this way. So I went to Catholic school. Some of you guys had the same background. And in Catholic school, you oftentimes have the penguins walking around, the nuns and the brothers who are walking around. And if you're goofing off, just imagine Sister Rosemary taking what are those, erasers, and just flinging it across the room and smacking you in the head. And that's kind of a whack telling you not to do something. The taxation is the same thing. There's penguins walking around smacking you in the head, and that's when you're earning money at a job. That eraser that hits you in the head is actually the old age disability and survivors insurance, Medicare, FUTA, SUTA, L&I, all these things that get withheld out of your check before you even get your money. That's that little whack. And if you remember your first check, like I was working at McDonald's and I was making $4.15 an hour. I remember getting my first check and I was like, who are all these people taking my money? And I didn't understand how the government worked. That's a little whack. On the other side, you have when you do something good. In my school, if you did something good, they'd give you a little attaboy, or they'd bless you. They'd say, that's good, you're doing good, and then you feel pride, right? Well, in the tax world, that is real estate. They give you a lot of blessings when you go into real estate. And so the joke in my profession is, if you're paying taxes when you have real estate, it's because you don't own enough. And I'll show you how to leverage your real estate to get some tax changes. To get some tax benefits. Stuff that we're going to go over is just some of the tax laws you might want to be aware of that are existing now. There's some ways to get some extra money out of your properties. I'll give you like a little primer on depreciation and its recapture, how to segregate out assets, some things that are kind of this mystical area that you may have heard of, but I'll try to make it make sense so you understand practically how it impacts you. And then we'll talk about some of your timing options. Like there's still some things that we can do in 2021 that'll affect last year's taxes if you want to. Like there's in real estate, there's a lot we can do all the way up until October that will affect last year's taxes. So it's like it's never too late to engage in a little tax planning, even if it's after the year end. Tax law changes that you should be aware of. The above the line charitable deduction, if you're not aware, there was $300 in 2020 that without even touching your Schedule A, without worrying about state and local tax deduction, you know, my medical expenses, my mortgage interest, without having to go onto your Schedule A of your 1040, you can write off cash that you gave to a charity for $300. In 2021, that goes up to $600 if you're married. Otherwise, it's $300. You can now write off 100% of meals if you use a restaurant. So if you take some client to a meal, you can write off 100% of it in 2021. Solar, they extended the 26% credit. It's a tax credit. It's not a deduction. It's a tax credit. So if you spend $10,000 on putting solar on a rental unit, you get a $2,600 tax credit that you can use dollar for dollar against your tax bill. But also, you can still depreciate and write off that solar array. There's a little bit of a difference. You have to reduce the cost of it or its basis by 50% of whatever that tax credit was. So it's 26%. You'd take 13% off of whatever the cost was, and you could still depreciate that in year one. So a $10,000 solar array would give you not only a tax credit of $2,600, but you'd also get to write off $8,700 against your other income, against income. So that's pretty savory if you know how to use solar. And if you know that I've never met a $10,000 solar array, like it's always 20 or 30,000, you can still finance it and get all those tax benefits and front load it. So again, if you're really profitable, these are things that you can do. The tax rates went up a little bit. You should just be aware of that. Mileage, the big thing on mileage is that in 2020, you could reimburse 57.5 cents per mile of your business mileage that you're involved in your real estate. In 2021, that's going to be 56 cents, and that's because energy prices are going down. We'll see if that continues to take place, given that they just nixed the pipeline. So we're not going to be using Canadian oil as efficiently. 401ks, you can now implement a 401k. Yeah, even for last year, you could actually implement it now and make a company contribution. So if you're an S Corp or a sole proprietor, that may be something you want to look at. If you have a business, it may be something you want to look at, because you can make the employer contribution up to 25% of your wages. That would be deductible. You can make that all the way up until the company files its tax return. So for some of you guys, you're going all the way into October. So you can get some tax relief for last year. There was an early withdrawal benefit that was under the CARES Act that was passed in March of last year. Keep your eye out for this, because I think that in the next stimulus that they're going to put something else in place similar. What that early withdrawal allowed you to do is take up to $100,000 out of an IRA or 401k, 403b, 457 plan, and not pay the early withdrawal penalty on it, and then spread the tax over 3 years. So that's interesting, that I could get $100,000 and basically I would pay I would recognize $33,000 of taxes here. And there's a little rub on it, is that if you pay it back by the end of the third year, you don't have to pay tax on it at all. So you amend all those and get your money back on any taxes paid. So be on the lookout for that one to come back in this year, because it's a source of funds. And so I tell people, if you're doing the early withdrawal, it's for COVID, but if I have impact from COVID and I would have been investing, this is money that I can use for my living and I can invest the other. So it gives me an opportunity to perhaps become a little more liquid to take advantage of opportunities as they come down the pike. Although ostensibly what you're saying is, hey, I'm using that money because COVID's impacted me. There's the unemployment benefits have been extended more time into, I think we're looking at March. So if you have had your employment affected, you can get the federal benefits and continue to supplement even under the pandemic unemployment for non-employees, but for the gig workers, that's still there. The other one, and this is if you are somebody who didn't take a paycheck protection program, a PPP loan, you get you get payroll tax credit, and there's also this employee retention credit. The payroll tax credit, actually, you would get even if you did the PPP loan. The employment retention credit would be only for those of you who did not take a PPP loan. And what that allows you to do is take a tax credit on a portion of your employee's income. It's income up to $10,000, but you'd get basically up to a $7,000 tax credit if you have employees. And then the last one to be aware of is this thing called required minimum distributions out of IRAs, 401ks that are traditional plans. And this might be something that's more important to your parents. In 2020, they weren't required to take required minimum distributions. Again, I'll watch this one closely to see if they push it into 2021 as well. There's been a number of tax acts passed in this last year. They're in the stimulus programs. They stuck things in the budget bills. There's all sorts of laws that are being passed, and of course we've had upwards of almost 40 executive actions by the executive branch this year, the president. So just keep your eye out on some of these things because there's impact that's occurring in all of these. And then of course we have some promises made by the new administration that they want to increase taxes in certain areas and give benefits to others. I'd really be watching the alternative energy areas and how it impacts your real estate investing, and also looking for incentives like carrybacks. They passed some last year. If you weren't aware, if you're a real estate professional, you could actually carry back any losses that you generate for 2020 back all the way to 2015 if you want. And you could actually go back and do the same on 2019 and 2018. So technically you could go back 2013 on some of those. Be on the lookout to see if they do that in 2021. And the reason I say that is because you can create tax losses on new purchases that can go back and get you some of the taxes that you paid years ago. If you were in a high tax bracket, it may be worth it to do that type of planning. And it's just math. It's just sitting there saying, is this available and would it benefit me? And if you were paying money in the 30% plus tax bracket, sometimes we look and say our best road is to go back and get some of it. And it's not expensive to go back and get. It's something that you're entitled to. So if you remember Donald Trump, there was the Wall Street Journal came out with an article about him going and not paying taxes, carrying back $90 million of taxes. It was actually this precise scenario during the Depression. They gave a carryback and said you can carry back 5 years of ordinary loss. And so it just Trump Tower. So he had these massive real estate losses available to him, and he carried back and wiped out his taxes for the previous years and put, I forget what it was, like $37 million in his pocket. That's all it was. And so sometimes Congress passes these to stimulate the economy, so I wouldn't be surprised if some of those things are negotiated in the next stimulus. So just be aware. It's kind of like, could it impact you? Maybe. Be aware because it might be an incentive when you're dealing with a buyer of property, because they may be looking at it. And so you may want to, like, if you improved a property, if you kept good records, that's a carrot you can dangle over their head of, like, it's a cheap segregation. I kept a track of all my invoices, and I'll make those available to you if you're going to segregate this property, which by the end of tonight, you'll know what that means. Fun stuff on real estate taxation. This is all the excitement right? So whenever you're dealing with real estate, you could fall into a lot of different categories. I'm not going to go through all of these right now. I'm just going to tell you that whenever somebody like me, I'm just, again, tax lawyer guy, I sit here and talk to clients all the time. And if I start trying to figure out what type of real estate you're in, there's a reason. It's because I'm thinking through my head, what type of incentives could I get out of this? Or are there certain things that I can't get access to because of what you're doing? So some people will say, well, I'm Airbnb. I'll be like, great. There's 3 different types of Airbnb from a tax standpoint. There's people that are, the average stay is less than 7 days. There's people whose average stay is less than 30 days, but they provide services. And then there's people that the average stay is more than 7 days and they provide no services. Those are all taxed differently. And so, most people are unaware that there's all those different categories. Or if I go into a syndication, if it's a limited partnership, that actually has an impact on the investor that could negate a whole bunch of benefits that specific investor is entitled to, because too much of the income, too much of the gross rents is coming from that limited partnership interest. A guy like me knows that could cost you tens of thousands of dollars, if not more, depending on what you're investing. And so something as benign as, hey, I'm going to invest in this syndication could have a tax impact. You want to know going in. On the same token, an investment in an LLC syndication may reap you an additional $30,000 or $40,000 of tax savings. And you might want to know that when you're investing. Hey, I'm going to put, $500,000 in this syndication. I might want to know if it's going to give me a big, huge tax benefit going in, because that might decide whether or not I go into it or not. There's the old joke, if you ever followed a guy named Robert Kiyosaki, he always talks about his investing now is for the tax savings. 9 times out of 10, he's going into it because he's like, hey, I want to shelter some of my other income. And that's why I'm buying it. I'm not buying it because I need more investments. I'm buying it because I don't want to pay tax on my income. And it saves me 30 cents on the dollar or 40 cents on the dollar, in some cases 50 cents on the dollar, depending on where you live and how much you're making, to invest in this. So it makes a pretty big impact. And so I just throw that up there. I'll share you guys all these slides, Elisa, so that if you wanted to give it to them, so that you could say, oh, I'm here, and oh, this is kind of an interesting section. The big one is depreciation. Whenever you're investing in real estate, the easiest way to kind of conceptualize this is, if you were in a business, a regular business, say you had a restaurant, and you bought something, you'd want to know whether I could write it off. So if I bought a table, I'd want to know if I could write it off. Well, when you're in real estate, that table is actually your building. So if in a restaurant, that table is going to have a useful life that I would deduct it over a period of time, unless it's considered a piece of equipment, or I might be able to accelerate it. Maybe it's furniture, might be 7-year property. Some of it might be equipment, it might be 5-year property. And then I might have a rule that says, like in the tax code, it's 168K right now, that says, hey, I could write it all off in 1 year. I could write it off if I want. The same thing is true of real estate. However, there's a default. And the default is, hey, if I buy a building, if it's residential property, I can write it off over 27.5 years. If it's non-residential or commercial, I'd write it off over 39 years. And they say everything in that building is 39-year property. Even the carpeting, which we know isn't going to last for 39 years, we're going to treat it as though it's going to last for 39 years. And anybody with a, that's in real estate knows, well, wait a second, that's not true. If I have residential real estate, I know that every time I change out my tenant, I'm either doing a deep clean on that carpet or I'm swapping it out and repainting it. I don't want to write that off over 27.5 years. I want to write it off earlier. And so that's where we get into some fun stuff, where we start saying, let's opt out of that category and let's treat it differently. So stuff we want to know about depreciation. Number one is kind of how it works. It's a deduction. If I make $1 and I have $1 deduction, how much tax do I pay? 0. So what we care about is the $1 that I make, how much of it is actually taxable, and how much is that deduction, and making sure that these things pretty much match up and align. In order to do that, I need to understand my basis. I need to understand also whether if I write a deduction off, whether I have to recapture it and pay tax on it someday when I sell. And then we want to say, hey, if I could write something off, can I write off something that would normally be 27.5 years? Can I write it off in a smaller period of time? Could I write it off in 1 year, 5 years, 15 years, whatever it is, 7 years? Could I write it off over a shorter period of time? And then if I can write it off and I can create more deductions than there's income, can I take that and use it against my W-2 income or other sources of income? And that brings us into the real estate professional, because that will change. I'll go back to this little slide here. When you are a real estate investor, for example, I'll just circle this for you. It's considered passive, and the rule is passive income offsets. Passive losses offset passive income, unless I'm a real estate professional, in which case it becomes ordinary, in which case it will offset all other types of income. So when you hear somebody say, oh, real estate professional status, what they're really saying is, I don't want my passive losses to be treated as passive. I really want them to be treated as ordinary loss, in which case I can use them against my W-2 income, the profits from my business, my spouse's income. I can use it against anything, as opposed to having to use it just against other passive income sources. Let's just kind of go over some of the stuff of how taxation kind of works. Generally speaking, if you have an active business, if you're a sole proprietor, it's going to go on to Schedule C of your 1040. If you're an investor, it's going to go on Schedule E of your 1040. So your 1040 is your federal tax return. You have this passive activity, which I was just talking about, where the general rule is passive losses, I'll write that, losses offset passive income. And there's two types of passive income. The type that we're all familiar with is rent. That's passive income. That's the only kind of passive income. Rents are passive. Then you have businesses that you're a silent partner in, that you do not materially participate in. In other words, let's say that your Uncle Joe has a pizza shop and you gave him $10,000 startup money and you own 20%. If that profit comes down to you, if Joe says, hey, we really did well in the pizza shop, there's, your 20%, we made 100,000 last year, you get $20,000. That's considered passive income. So if you have $20,000 of real estate loss, you could offset that $20,000 of silent partner pizza participation. You could offset it, so you don't have to do it. The other exceptions to that rule, where I could take my passive loss and make it into ordinary, is if I actively participate in my real estate, in which case then I can write off up to $25,000 of my other income. I don't have to worry about whether it's passive. So if I have W-2 income and I'm an active participant in my real estate, and active participation means you hire a manager. You oversee it full. You don't have to spend any time on it. I could just say, hey, I bought this rental property in the middle of nowhere, but I hired the property manager. That's active participation. That means that I can take up to $25,000 and offset it. But this phases out between $100,000 and $150,000. So if you make too much money, it phases out. Then we have this guy right here, this real estate professional, and I'll get into it in a second. I'll go over the rule on it. The real estate professional, all of your passive loss is treated as ordinary. And if I went back into the history of the passive activity loss rules, it was 1986. All the doctors in the United States before that would just buy passive income stuff and write it off like crazy, and then they wouldn't pay any tax on their doctoring income. So Congress says, that's not fair. You're making $500,000 a year, you should have to pay tax on it. So they said, hey, unless you are in that industry, unless you're a developer, a construction person, unless you're a realtor, unless you're a broker, it's passive to you. You can't offset your doctoring income. And in this area. And so they carved off this little exception for those people. So originally they didn't have it. So all the developers and stuff, they couldn't take those losses. And they're like, what are you talking about? This is my world. This is what I do for a living. Why not? And they managed to get it through a few years later to carve off the exception. It's 469 of the code. C7 is the subsection, but you can go read it if you feel like. I'll kind of give you a once over on it. Let's go over the basics that everybody here should understand. When you're looking at basis and you hear that term, people throw it around. There's different types of basis. Like there's basis in a partnership. There's inside outside basis in a syndication. There's basis in a business. There's basis as an S corp. I'm just going to focus in on real estate. Your basis is what you paid for the property. And then we have our depreciable basis. And that depreciable basis is what we get deductions for. And so we're going to focus like a laser beam. We're going to say, let's get rid of the land value. So we have whatever you paid for the land or whatever it is assessed. You can use sometimes we use the assessment because we want to use this percentage of what the land would be. If you have an appraisal, sometimes they'll say your land is worth X and your improvement is worth Y. But if we have an assessment and it shows that 20% of the value is land, you could also just apply it to 20% of your purchase price. So let's just say, all right, 20% is land. We bought a property for $500,000. We have $400,000 of improvement. That's our basis. We add in our closing costs, purchasing costs, things like that. But let's just use it and say we have $400,000 of depreciable improvement basis. You do not depreciate land. So we always take land out of it. Land does not get depreciated because it doesn't lose value over time. A building you have to replace over time. I live in Vegas. We like to blow up our casinos just to prove that point periodically. We blow them up. Let's build a new one. All right. So let's play a game. We bought a property for $140,000. The land value is 40. So we have a depreciable basis of $100,000, which means I get yearly depreciation of $36.36. For the CPAs and EAs out there and the accountants, I understand that the first year might be less depending on when we put it in service. But for sake of this, I'm just going to say every year is $36.36. So our depreciation kind of works like this. We have 100,000 yearly depreciation is $3,600. So let's say that we have rents of $700 a month. I use the rule of 50%. So I just really sloppily did my numbers. So that would be, how much is that a year? That's $8,400 of gross rents. So I just said, hey, about half of that's going to go to my bottom line. So I'm going to say I'm going to make $4,200. I take my deduction for my depreciation. So keep in mind, I have $4,200 in my bank account. I probably have more than that because I put some aside for my CapEx. I put some aside for vacancy rate and stuff. So I probably have, let's say, $5,000 sitting in my bank account. But for tax purposes, I'm only going to pay tax on $564. That's how it works. That's why people like real estate. So I brought in $8,400. I paid my manager. I did some repairs. I paid my property taxes, whatever. I have $5,000 sitting in cash in my bank account, but I only have to pay tax as though I made $564. And you say, all right, that's pretty good. Now, let's say that we bought a property for $200,000. I had my basis of, let's say that let's say that we sell that exact same property. So we're going to take this property. Remember that we bought it for $140,000. So that's our purchase basis. Now we're going to sell it, but we're going to sell it for $200,000. So we sell it, we take our basis. So we have this $60,000 that we'd say, oh, I made $60,000. But how do I treat it? Well, over the years, let's just say I sold it in year 9 or 10. So I took $36,000 of depreciation. What I would have to do is take the $60,000 of total, what I would say is gain. I would have to recapture my 36,000. So I only really have $24,000 of capital gain. So my gain is this number here, 24,000. I have recapture of 36,000. And the way recapture works is it's taxed at your ordinary rate. So whatever your tax rate is, but it is capped at 25%. So whenever you hear somebody say recaptures at 25%, that's what they mean. And so really good tax people know it's not really 25%. If I can create a big tax loss in a year, what is it going to be? What if I could write off a whole bunch of your real estate in the year that we have a recapture event? You know what you know what your tax is? Yes. 0. In your capital gain, long-term capital gains, if you are in the $0 to $80,000 range, is 0. So what we usually try to do when you're doing tax planning is you're like, are we selling anything? We're going to have any capital gains? What should we do? Are there ways to avoid it? Yeah, we could 1031 exchange. We could do opportunity zones, or we could just buy something else and depreciate the heck out of it and create a loss that year so that you're at 0% on your recapture and your capital gains. And then people are like, yay, I like that route. That's fun, right? Not having to pay tax on things. Then now let's make it even more fun. So remember I was talking about the default is 27.5 years or 39 years, depending on whether it's residential or non-residential. In residential, it's a percentage of how many units are being used for people to live in. So it's an easy test. But if you're buying apartments, if you're buying single family residences, duplex, fourplex, it's going to be residential. It's going to be that 27.5. What I can do is say, I don't think my carpet's going to make it 27.5 years. So I am going to do what's called cost segregation. And I'm going to break out my personal property, my 5-year, my 15-year property. And these are all examples. This is 5-year property. This is 7-year property. And then this is your 27.5-year property. The steel structure, the roof, the wood structure, the HVAC, plumbing, electrical, basic system. If I have specific things in a building, I could write it off. So a lot of the plumbing in the walls, I'm going to write off, especially if I'm depending on the type of a building I have. If I put in driveways, hedging, storm drains, all that fun stuff, it might be 15-year. And then all the stuff that I'm really spending my money on, the countertops, cabinets, all that stuff, that's 5-year property. Why is that important? Because somewhere in the neighborhood of 30% of your property value of that improvement is 5, 7, or 15-year property. And under section 168 of the code, I could choose to write that all off in 1 year. I could choose to take my 5-year property and just write this off in 1 year. Say, oh, that's 1 year, bonus depreciate. Or I could take my 15-year property and write that off in 1 year and spread out the others so I don't create huge losses. So I can actually engage in some planning to say, all right, let's say I look at Annie there and I say, Annie, we want to show some income because we're still getting loans, but let's show $100,000 a year instead of $300,000 a year. Would that be okay? Let's not kill ourselves on tax. Let's spread it out over a period of time. And I'll show you a case study. So this is an actual segregation study that I worked on with Eric over at Cost Segregation Authority. Super nice guy, Eric Olivers, the CPA firm that all they do is segregation. So I sit there and we break down this property, and I'm going to change it so you can see my ink color. I know that it's hard to see on some of this, and again, I'll give you guys the slides. But on a typical 2019 carried forward structure, the depreciation basis was 1.2 million. And typically you're writing that off over a long stretch of time at $21,000 the first year, then $43,000 a year. When we did the cost segregation study, we broke it down into 27.5 year, 15-year, 7-year, 5-year property. And you could see the totals over here. There's a lot more depreciation that I can get. So the increased amount is over here. My increased tax savings as a result, I can also look at depending on what tax rate I'm at. So if you're married and you have a spouse that's doing W-2 income, and you have W-2 income and you have your rental property, we know what tax bracket you're going to be at pretty much every year. Let's say you're making $150,000 a year, right? You're in the 22% tax bracket plus your state. So we can figure it out and say, all right, every dollar is going to be taxed at least this amount. So we can pretty much figure out what your actual tax savings are. And we could say, hey, instead of taking it over a longer period of time, let's just front load it. So in this particular case, the actual present value of the tax savings. So just in year one, the tax savings was $17,529. And then in the first 5 years, we were able to get a present value of tax savings of another 49,000. So, or 800, really 50K. I'll just make it simple. So another 50K. So we had a nice big tax savings event. And that was cash that's in the person's pocket of taxes that they don't have to pay. And that's one property. I'll use myself and Clint as a real life example. So we own a lot of real estate. We've had them for some of them for, going more than 20 years. So we will have a situation periodically when we do our taxes, and we'll be sitting there and you'll have an extra $200,000-$300,000 of positive cash flow coming in, or a taxable real estate income above your regular depreciation. So this happened 2 years ago. We had a couple, I think it was 260 was the amount of income that we were going to have to show each on our K1s from the real estates that we hold. So we said, hey, you know what? One of our buildings in Vegas, we just decided to cost seg it and accelerate the depreciation, because you can do this even on used property. On any building, you could do this. So even if you've owned it for 10 years, you could still go and redefine the personal property from the structural. And we were able to wipe out that tax liability by doing a single cost seg. Well, comes this next year, so 2019 taxes, we were doing them. We like to wait until the last second. So we were doing them in October. And we're looking at it going, oh crap, same scenario. We're about $300,000 of positive income. And you're like, I look at Clint, like, do you want to pay tax on that? He's like, no, I don't really want to pay tax on that. That's on top of everything else. And our firm does well. And we have a lot of other business interests. So like, oh crud, So all we did is we segged one of our buildings in Tacoma, Washington. And it was the same scenario. By doing that one segregation, we were able to wipe out that 1 year of taxable income. And it literally, you're just going around saying how much depreciable basis. Rule of thumb, on a commercial building, it's probably gonna be closer to 40% of the depreciable basis. On a residential, it's probably gonna be closer to 30%. And by the way, don't go cheap on a segregation study. The difference between 20 and 30% is a lot. And that's about the difference between doing a cheapy study versus actually having engineers look at your house. So you want the higher amount. It's not earth-shatteringly expensive. On a house, it might be a couple thousand, maybe 1,500 to do a segregation study. So we looked at this and we said, oh, this is the property we need to use. Next year, we're probably gonna be in the same scenario. We might say, do this one and this one, or this apartment complex. Maybe we'll do it. The thing about passive losses, like I am a W-2 wage earner for my firm. I could never be a real estate professional because I don't spend more than half my time. Here's the actual real estate professional rules. You have to do more than 50%. It's actually, this is 750 hours and more than 50%, one half. So we have this two-pronged test. I could never meet it. So I'm always going to have passive real estate losses, even though I am active in my real estate. My wife does not do real estate. If she qualified, we could be real estate professionals, but that's not her interest. So I'm sitting there, and Clint and I are both in the same scenario. if we have real estate passive losses, you don't lose them, you just carry them forward. So we just sit here and we say, we could either do a bunch of segregations in 1 year and then just carry it forward, or we could look at our tax situation each year and decide whether we're going to do a study. And we could do it for, like we did it for 2019 in 2020. We're going to do the same thing this summer or this fall. We're going to see where we end up for taxable income on our real estate. And then we'll decide then, do I want to do a segregation? Maybe. The study itself is like, I could get the numbers ahead of time for free. Like our guys are good. They'll go through and they'll figure out based on the type of building about what they get per, you know, you could say, all right, this is what it's worth to me. And that's where the timing comes in. You can go back. So I know that I probably went over a little bit, Nelson.
No worries.
But
This is really good information. So I think it's I don't want to sound like I hate it when people are like, yeah, it's great at providing value, but it's like this is useful. Yeah, so keep going.
oh, if you're okay, like I can go back and have lots of fun on different strategies that you could use. I was just going to say that if anybody wants to do have their numbers looked at, it doesn't cost anything for your group because that's what we agreed to do. You could schedule a free session. There's the link to it, is just aba.link, Elisa. And then we made it easy. Sorry, Elisa, because we just steal your name to put it on things. And all you do is you put a little bit of information. There's no credit cards or anything like that. You're just saying, hey, I want someone to actually look and see whether there's any possibility. So it's a freebie. We love working with real estate investors, and you guys are all real estate investors, right? Yes. Are there any questions that popped up first off?
Perfect. All right, let's go through the whole list. Actually, I have a personal question first. Are y'all real estate professionals on your taxes, or are you like legal? Like, what do you guys usually write off as?
No. So the way it works, let me go back to that. The actual rule is to be a real estate professional, you have to be in one of these categories. This is actually the code. So this is 469C7. And for purposes of not being treated as a passive activity for loss purposes in real estate, they have this carve out for real estate professional. And it means that you're in the development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage, trade or business. Not on your property, just in general. So if I am, if I own my construction company and I have to own more than 5% of it for this time to apply, then then I'll meet this test. And it has to be more than 1/2 of my personal services and more than 750 hours. So we go to the next section where they have this test. So they look at it and they want you to keep track of your time. So, you know, everybody has one of these. Just use your phone, put it in your calendar and say, I did this. Or if that's what you do for a living, like if you're a realtor, if you're a property manager, you're going to have a real easy time because that's what you're doing. One spouse has to qualify for this. Then, and that's, everybody always says where, and that's what it says right there. In the case of a joint return, the requirements of the preceding sentence are satisfied if and only if either spouse separately satisfies such requirement. So they don't add you up. But for material participation, which is the next prong on your real estate, you add both of you guys together. In material participation, you have about 9 different tests that you could qualify under. The end all be all, the greatest test is if you do more than 500 hours managing your real estate. And here's the rub. It's per property unless you elect to group and aggregate all your real estate activities together. You have to make that election. And the court has lots of cases of people that were real estate professionals and their accountant didn't know what they were doing and forgot to make an aggregation election, and they're unforgiving. They say, yep, you didn't do it. If you don't, it's per property. So there's a great case where they had 3 properties and they had met the 750 hours, but it was for all 3 properties together, but their accountant didn't elect to treat them all as one activity. So they had to meet the test per property. In the court, if you notice, I said 750 hours. It's actually the material participation test is as low as 100 hours, but the court screwed it up because the IRS and the tax attorney didn't know what they were doing in tax court. So like we ended up with this crappy case because we're looking at it going, they used the wrong rule. Like the 750 hours is for the individual. The material participation on your activity is per property, but if you're self-managing, you don't even have an hourly requirement. If you're managing, if you're using a third-party manager, you can get by with as little as 100 hours a year total on all of your properties. And so then you just add them up. So yeah, so Nelson, to answer you this question even better, if you have one spouse who's a really high W-2 earner, so I'll use a real life example of a couple doctors we have. One spouse, the wife in this particular case, is a surgeon making a ton of money. The husband does real estate and manages the real estate. So he's a real estate professional. We were able to cost seg and get them 180,000 plus. It was $183,000 of tax savings in year 1 off of their real estate, because we were able to take a bunch of the real estate losses and offset her W-2. She was making close to $1 million a year. So we were able to knock away over $500,000 of it. Boom, because only one spouse has to qualify. Sorry, go back. Ask question.
We have a question regarding 1031 exchange. Someone asked in a 1031 exchange, how do you calculate the new basis for depreciation?
Right. So the depreciation is part of it. So when you 1031 exchange, it's not just capital gain, it's also the depreciation. And you can actually 1031 into using accelerated depreciation as well, so long as the replacement property or properties elects the same to treat it as accelerated. So you have to do cost seg on the property that you're acquiring. So the easiest way to think of a 1031 exchange is if I bought it for 100,000, it's now $2 million property. It's gone up like crazy, or I've held it for 30 years, and now I'm going to sell it. I just have to buy equal value property no matter what. And it's just real estate. So it could be land, mobile home, condo, single families. It could be an apartment building. It could be a warehouse. It could be commercial. It could be residential. It doesn't matter as long as it's real estate, and any combination. It doesn't have to be one property. I could buy 20 properties as long as the real estate value is the same. And then my previous basis rolls into that new property for that value. If I buy properties that are worth more than that, then I have more depreciable basis. If that makes sense. I'll have more depreciable basis to write off. And then here's what happens, and this is what they're going to goof with us. If they're talking about taking away the step up in basis. Normally what happens is I depreciate my property. If I sell it, I roll it into new properties, and then I die, and my basis steps up, and my heirs redepreciate that same property again. They take all the tax benefits again, and then when they pass away, it steps up, and their heirs redepreciate it again and write it off again. Like the thing about real estate is, like, you should trade it for more real estate or otherwise never sell it. Somebody says there's a whole bunch of questions. Why don't you ask them?
I'll keep going too here. Let's see. If I have a rental loss from 2020, so like negative 5,000, can I reduce my W-2 income that I report from the rental?
So the answer is maybe. You have to fall under one of 2 exceptions, and that is active participation. So if you're making less than $100,000 and you actively participate in your real estate, so you hired the property manager, then yes. If you are if you're a real estate professional, but you said W-2, so it's probably going to be really hard for you to be a real estate professional unless you're in the real estate realm. But you could be in that category too.
All right. Then So someone asked, what are your tips and best practices you tell clients to make during tax season so that they're more efficient and free of stress?
Oh, keep books during the year. Taxes are easy if you have good books. So bad books means your accountant is charging you a heck of a lot of money to run around and try to figure out what your numbers mean. So what I would say is, at least on a quarterly basis, figure out where you are for the year. If you have real estate, best trick I could give you is when you own lots of pieces of real estate, have one QuickBooks account and treat the properties as classes, not as separate books. So I could have one set of books and I could have 50 properties and they're all different classes under one set of books. Or you could do it QuickBooks says and have a separate set of books for each property, which case you have to open up and buy like each account. I don't know if you've ever done this before. Bookkeepers are already having PTSD from me just mentioning this because they know they have to close one set of books and then open up the other one and it takes 5 minutes and it's a pain. So the best thing is just to treat it all as one big old activity. And you don't even have to have QuickBooks. The best thing is have a bookkeeper and just keep a spreadsheet in whatever manner you want, and then let somebody else do the QuickBooks. Have one set of books. And it's even better if you never touch QuickBooks because it's there's a learning curve in it. It's a pain in the butt. Don't mean to be blunt, but it is.
Oh, we have a question earlier asking about the different entity structures and what entity structure to use for different investing strategies.
Yeah. So if it's me, I'll break this down for you. Actually, I'll go back to the slide where I had them all.
Oh yeah, the table I think is super helpful.
Yeah. So whenever you see active, and I'm going to change my color here. So whenever you see active, think S or C Corp. Notice I didn't say LLC because an LLC does not exist in the tax code. An LLC can be taxed as an S or a C Corp. So if you're Airbnb and your average stay is 7 days or less, then your Airbnb business will be an S or a C Corp. LLC taxed as S or C Corp or just a regular old S or C Corp. If you're a real estate agent, you should be an S or a C Corp. You should not be ever a sole proprietor if you're making more than like $25,000. You're throwing money away and you're giving yourself liability that you don't need to. If it's a syndication, I'll make it easy. It should be passive. This is going to be partnership almost 100% of the time. And it could be an LLC taxed as a partnership. But from a tax standpoint, you're almost, I haven't seen a syndication that's not a partnership in forever. If you're an investor and you have passive income, you want to be, if it's a husband and wife living in a separate property state, or if you're doing loans on properties, you're going to want to be a partnership, or you're going to be what's called disregarded. And again, you could be an LLC taxed as a partnership or an LLC that's disregarded. And if you're an Airbnb business, this is where it gets fun, right? So if I say, hey, my Airbnb business is a corporation, but I have the real estate separate now because I don't want to have my real estate be an active business, then I lease the property to my host business, and I'm able to get all the benefits over here, all the real estate benefits without screwing them up. If you're following along. So if you're an Airbnb person, there's a workaround to make sure you get all the benefits without any of the nasty stuff. Hope that makes sense.
And then for the active side for syndications, that's S Corp or C Corp, right? Just to curious.
Yep. If you are the syndicator, so in a syndication, and you are the manager, so you're the person who's doing it, then that's an active business. So the syndicator if you can read that, is going to be an S or C. They're an active business. So if I'm putting the deal together, the way you're almost always going to see it, and I'll just put up a black screen and this, the way a syndication's almost always going to work is you're going to have the investors put money in an LLC. It's going to be taxed as a partnership, which is a 1065. And you're going to have the managers in their separate LLC that is going to be an S or a C corp. And they're going to be their little piece, and they're going to make their money. And this is going to, the money they make is active. Then the money you make as the investor is passive. Unless, what are the exceptions? You guys should know the exceptions now. It's going to be passive income no matter what. But if we have lots and lots of loss and we don't want it to be passive loss,
Segregation.
Oh,
then I'm either going to be real estate professional or active.
yeah.
And you guys, you know, if you make too much money, you're never active. So it's really just real estate professional is the only game in town. You're doing it.
Got it.
See, it's simple.
Yeah. Thank you.
Everybody makes it hard.
Another question, I know we already talked about it during our prep call, but I think it's important for a lot of our members. We had this question, if you are buying your first rental property, do you need to put it in an LLC or an entity?
Yes, good question. So the easy question is, what do I have to lose? So I'm going to use a doctor. And they make big bucks. Let's say they make $1 million a year. And they buy rental property. Where do you guys like to buy rental properties, by the way?
I'm in Chicago and going to Texas. What about?
All right. So we'll make this a Texas. I have lots of Texas stories. Oh, we got lots of good Texas stories. So let's say I get my nice property in Texas. What do I have to lose? Let's say I paid $150,000 for this property, and I even have a loan on it of $75,000. So my equity is $75,000. What do I have to lose in this scenario?
75,000.
And my $1 million a year. Unless I put a box around this. So let's say that I have big Texas. I'm going to property manager. And property manager comes across tenant, and tenant is big drinking tenant and pisses off property manager. What does property manager do? Pulls out his big gun, shoots tenant. Because property manager is mad. Do you think landlord could be responsible for that? It's his agent misbehaving, and now all of a sudden you have a wrongful death, and you want to make sure you have a box to contain it. That's actually a true story. But let's just say another true story that happened in Texas. Somebody loved their property and it had a beautiful tree with a rope swing on it. And they got on the swing and the branch broke, and guess what it did? Fell on tenant, squished tenant, tenant sues. If you do not have a line of defense of some sort of box around this property, they will literally they will garnish your wages until you are dead. I garnished on behalf of a landlord. It was actually a tenant that destroyed their property. And that tenant worked for Boeing. It was one of my first cases when I became an attorney in Seattle. And it was a friend of mine, landlord. So I just took it pro bono, right? I sued that person who did that. They took a claw hammer and put about 500 holes in the walls on their way out of a property because they were mad that he evicted them. because it was the gal's kid that was selling drugs out of the house. It was in Tacoma, Washington, just to give you some background. But so she got mad that he was evicting because her baby would never sell drugs. Yeah, he was dealing drugs out of there all night. Every time it was that was the place to go. So she took a ball hammer and just went through the whole house. And so we sued her. And they were dumb enough to try to contest it. They should have just said, "Yeah, I made a mistake, and let me pay to fix it." It ended up being about a $50,000 judgment. And then she tried to bankrupt it, and you can't bankrupt away intentional acts. So I filed the exception in bankruptcy court, and we garnished her for 11 years. We got every penny plus interest, all the costs, and you can't get away from it. So that's a bad actor situation. This is a situation where you're not a bad actor. You're just trying to invest, but you don't want that $75,000 of equity to put $1 million a year at risk. So we just put a box around it, and that's an LLC. And so people always say, should I use it, or isn't insurance enough? I have so many stories of insurance. The exclusions in those policies is pretty much just about anything that could happen. So mold was a big one. It's almost always an exclusion. Pandemic isn't covered by insurance. So like you have COVID issues that are popping up all over the place. You have discrimination. You have all sorts of stuff that may not be covered under a policy that you could be personally responsible for. So the easiest route is to say, you know what? Put it in a box. Make sure that the most I could lose is that property. And then leave it at that. And I don't care whether you have one property or 100. Don't depend on just insurance. It doesn't mean don't have insurance. Always have a regular policy, and do have an umbrella. Somebody says, what are the downsides of the LLC? There really aren't any, except the cost. You have to set it up, and then you have to maintain it. Some states it's super cheap. Other states, like California, they want to charge you $800 a year. There's a workaround that I would actually use a disregarded limited partnership, or I'd use a trust, and I can avoid the $800 a year fee. So there's some ways to do it, but there's no downsides otherwise. In fact, when I first started doing this in the 90s, it was routine that you would buy a commercial building and people would own them in their own name. Now think of an apartment building or any sort of building where they wouldn't force you to put it into an LLC. It's almost impossible. You cannot get a loan on a commercial property without having two LLCs nowadays. They're almost always going to make you do a combination of two, because they don't want the liability with them. So they do one that owns the other, and they'll loan it to the other, but they'll secure it with both so that they can take your company away from you. They don't want to mess around, and you will need one for each state. But it's up to you as to whether you, like, if I buy a package of properties in North Carolina, let's say I buy 20 properties and they're $40,000 a piece or something like that. I'm buying some little, C, B level, really C plus properties. I might put 5 in an LLC. I might put 10 in an LLC if they're cheapies and I'm not worried about losing them. But what I won't do is own real estate in my name. Unless it's my personal residence, I don't do it. And even in my personal residence, I'm going to put it in a living trust, because I don't want to ever have to probate it. So you're not, like, the easiest rule of thumb is don't own real estate in your personal name, because you have an expiration date. You could do something that gets you sued and they take the real estate, or something happens on the real estate and then they take everything you own. So just make sure that it's isolated.
Thank you. And
Thank you.
then we have another question. Someone asked, they are setting up an LLC with 2 other partners to purchase a property. What's the best way to set up disbursements of the monthly rent, return of capital to minimize it being reported as earned income? And should this be paid out monthly, quarterly, or annually?
Those types of questions is really up to you and your partners. So your LLC can be like in that case, I would have an LLC taxed as a partnership, and you guys would not be taxed as active if it's rental real estate. The nature of the real estate dictates whether it's active or passive. So if I'm flipping a house, and this is, again, there's so much bad information out there. Flipping a house has nothing to do with how long I held it. It has to do with what did I buy it for. So there's cases of properties that were held for 10 years that were treated as active ordinary income because they bought it with the intent to sell it. And even though they held it for 10 years, it didn't overcome the fact that when they bought it, it was the intent to sell it. So that has nothing to do with anything everybody thinks it has to do with. If you buy a property for rents and appreciation, it's passive. It doesn't change the nature of that at all. So you're always going to be passive. The question is, when you're making, if you're just taking out the rents, always going to be passive. The only thing we ever get to move around is whether the passive losses can be treated and used as ordinary. But it's always going to be passive income. I promise you that. So I would end up setting up an LLC. If it's me and I'm going to be the one who's running it, I want to be the manager. So I would set up a managed LLC. And then I would say, what are we going to agree as far as our distributions? And I would put that in writing, and I would make it, in order to change that, I would require unanimous consent. And that way I could run it. Everybody knows what to expect. It's kind of like a private placement when you go into a syndication, if you guys have done those. It spells it out in the offering memorandum and in the operating agreement. It says, here's when we're going to make distribution. Here's how much we're going to keep aside. If we need money, here's how we're going to get it. So usually you have a capital call provision that either says, I'm not going to force you to put money in, but if we need money, everybody gets a chance to put it in. And if you choose not to, then I can increase my ownership by putting more money in if we need it. You know, so you allow somebody the opportunity to bail it out without having to worry. But you put that in your operating agreement.
All right. I think that's actually it for questions. Sorry we held you for so long. I guess people were really
I
interested
think
in
we have
that.
one more, sorry.
Sorry,
Yeah, dude.
Someone asked, multiple properties in different states, should they have each property in a separate LLC? Or
Yeah, this gets interesting. So this is what I do. So there's you, and you want to interact with your properties. But if you have a whole bunch of LLCs, and let's say this is Washington, this is Texas, this is California, this is Georgia, and I have an LLC in each one, I don't want to have to do a bunch of different tax returns. So let's say it's me and my spouse. And I know I need to have a partnership tax return. Now, here's the difference between ignoring the LLC and having a partnership return. When I underwrite under Freddie and Fannie, if I have the properties on page 1 of my Schedule E, I get 70% credit of the income. If it's on page 2, which is where a partnership K1 goes, I get 100%. So if you're growing your portfolio and you're getting loans, you want it to go on page 2. If I have commercial property, I want it to be a partnership, because in order for the buyer, the purchaser, to get through underwriting, they're going to need a tax return on that property. And if it's all going onto your 1040, you don't want to give them your 1040 and say, figure it out. You want to be able to give them the tax return on that. I've actually seen deals destroyed, big deals, over the lack of a 1065. But let's just say that I want to have everything in a single spot so that it comes to me nice and neat. I would have an LLC, and I would go to a state where they can never take away your entity. So I usually go Wyoming 99.9% of the time. And here's why. If me and my spouse, and let's say that I have kids, and those kids, let's say that they go out driving, and I'll give you a real life situation. Kid causes a car accident and somebody passes away. You see, we're dealing with a lot of dead people tonight, right? This is just real life. Somebody goes away. You don't want them to say, oh, I'm just going to go take all these LLCs, which they could do in all those states. Texas would be hard. California, I could get. Georgia and Washington pretty easy. If I put them all into a Wyoming entity, they cannot take them. The most they could get is a lien against that. It's called a charging order. What that does is it makes them be reasonable. If they think you are rich, in fact, if any doctors are out there, your insurance person has probably said this. If you ever get in a car accident, do not say, "Are you hurt?" Because I'm a doctor. No, doctor does not come out of your mouth unless it's, should we call a doctor, right? The second they hear doctor and you hit them is the second you had a small claim and now they have catastrophic injuries that their lawyer is going to say, it's likely Nelson's never going to be the same. That 30-mile-an-hour impact has really changed him. Everybody notices. Yeah, he's got, oh, it's not just soft tissue, but there might be some brain injury. You know what I'm saying? This is real, true, 100%. If you know any plaintiff lawyers out there, you know what I'm saying. They write the best fiction ever. This keeps them from going into your real estate. And this, by the way, is private. They can't even see it in a public record. They don't know you own an LLC. They don't get to pull your tax returns, as we learned with President Trump. Like, you can't just go grab somebody's tax returns. They can just not disclose them to you. So in order for them to figure out what you own, you would have to tell them. And that's, I could say from, again, a few decades of playing this game, you want to make sure that your stuff is private. If they can't see what you own, then imagine getting hit by a homeless person. You know, they get out and the car is just beat up. They're chain smoking and the door falls off and you're like, oh, don't even worry about it. I'll deal with my insurance company. Just, you know, that's what you want to appear on paper. Somebody says, is this specific for Wyoming? So the states that have non-disclosure, the best one is Wyoming and Nevada. Nevada allows nominee. Wyoming, you don't even have a list. There's some states where they don't have it necessarily listed in the state database, but they can still find you. So I just want to make sure there's no disclosure. In Nevada, I put myself on all my client documents because you can have a nominee that signs documents on your behalf, and that way nobody can find it. It's just, I used to use Nevada 99% of the time because it was cheap, but then they made their business license fee like $200 a year. And I said, you know what? Wyoming charges you $50 a year. I think I'm going to go to Wyoming. They have the same exact statutes. And we have offices in both places. So I just like, hey, you know, you want to have a nexus there, which we provide our clients. And that way somebody can't see it. Texas, not so much. Texas, they can still get to, though it's pretty strong protection now. But again, what I like to do is make sure that it's not there where I live because they can't take it. The best example is if you have a safe in your house and you have cash in the safe, there's still a chance they're going to steal your safe, right? But if your safe doesn't exist in your house, it's buried in a field somewhere in another state, they're not going to find it, right? And that's what Wyoming does. We're just taking it to another state, so it's not in your backyard, it's not in your house. A local judge doesn't have jurisdiction over it. The most they could do is say, hey, you know what, you can go try to get it in Wyoming. And I'm saying good luck because that's never happened. Well, there's one case where somebody was committing fraud using an LLC and they said, no, you don't get to use fraud. So if you're a criminal and you're trying to rip people off or you're committing fraud, they'll pierce that LLC and they'll give you the asset underlying it. But if you're just regular investor, there's not a single situation where they've ever pierced one. That stuff fun. I don't know. I think it's fun. I find it fascinating. I learned this stuff, by the way, pursuing other people. The way I learned about it was actually Nevada was the big one. It was a very large lawsuit that was settled for a very small amount, and then they realized that the kid, the individual, the adult, I say kid, but it was the son of a very prominent family, and they didn't realize until after they had settled. Then after they settled, they hired private investigators to start digging around, and they realized that this kid had access to lots of wealth. Like he had lots of like the spoils of lots of wealth, like a yacht and a bunch of really nice cars. They had no idea because nothing showed up in a background check, and they had private investigators try to figure out what he owned when he settled, and they couldn't see anything, so they said, oh, he doesn't own anything. They still could never find anything. The closest we got was we ran into an LLC that he had a card on, and we could see the LLC, but we couldn't see his name associated with it. And I said, wow, is that even legal? And then the more we dug, the more we realized, wait a second, you can't find anything out about these things. There's no way to figure out what this guy owns. He was definitely worth upwards of 8 figures, and nobody could tell what the guy was worth. And he was just, again, so they settled their case, and they wanted to know whether they could sue the lawyer who told them to settle, because like, isn't there a way to figure out what this guy has? And it's like, no. So we know that he had money. We just don't know how much and where he kept it, and nor could anybody figure out how to get to it. And that's when we realized, wait a second, we should be doing this for our clients, so that someone doesn't start to increase the value of their case because they think somebody has something. Real life example in California. I won't give you the scenario because you'd be able to look it up, but it was a situation where at a commercial establishment using a valet, and a valet ran into somebody and caused significant serious damages. The dad owned a business. The son owned the real estate. The son, we were able to get out like this. The son is worth considerably more than the dad. The dad had old school lawyer in California who said, no, and had his stuff pretty much exposed. He is still in the lawsuit. It's 4 years later, and is paid more than in attorney's fees than the son settled with right out the gate. And the son is worth considerably more than the dad. It's actually pretty comical. So the son gives his dad a lot of hard time. They're both like, he's very, very, very well off, but it's still, he's like, I can't believe I have to deal with this. And it's because they want to take as much, they think the dad's money bags because he's got properties all over Southern California, and they can see him, his name's on every LLC. So like, they're just squeezing him to say, oh, when are you going to write the check, sir? And, there's insurance involved, and they're trying to go excess policy. So the insurance company does something called reservation of rights, which says basically, we're only going to be responsible for your policy limit. We're not going to be responsible any amounts over. So that the dad now has exposure. So he's like, he's going to have to kick into the settlement. And he knows that all of it could have been avoided. All of it. Fun stuff.
Thank you, Toby, so much for your time and sharing your valuable insight with everybody. And I hope our members, I'm sure they learned a lot, and we encourage everyone to set up a consultation with Anderson and learn more from based on everyone's individual situation.
Yeah. Just remember aba.link Eliza/Eliza. And you guys can, again, we're easy to work with if you have any questions. And thank you for having me. And I love to get to share this fun stuff. Yes. I love real estate investors. You guys are in the right realm, especially this day and age where they can't print money fast enough. So we're all going to have a little bit of good time. And then also make sure that you're taking care of the lower income tenants. There's a lack of properties for them, and they're getting left out in the cold, literally. So do what you can to help out some of those groups. Don't always improve the property and immediately sell it. Sometimes it's fun to hang on to them, and it's still rewarding. Maybe you don't get all the money right away, but you'll cash flow over a long period of time.
Yeah. Thank you again. Thank you again, Toby. So yeah, make sure to get the link. We're going to get the PowerPoint afterwards. And there's a copy of the video on the Facebook group. And then we're going to put also up on the website. So yeah, thank you, everyone.
See you guys. Thanks. I'll send you, Eliza. I'll send you or Nelson, either one of you guys, I'll send you the slides right away.
Sounds good.
Thank you so much.
My pleasure. Thanks, guys.
Bye.
Hey, thanks.